There is a final promise that every great investor makes to themselves. It's not a promise of guaranteed returns or a life without risk. It's a promise to see the world as it is, not as it's presented in glossy annual reports or rehearsed CEO interviews. It's a promise to become an investigator, a detective of capital, before ever deploying a single dollar. For decades, the average investor has been told to read the numbers, to analyze the spreadsheets, to trust the audited financials. But what if I told you that the most successful investors on the planet, figures like Warren Buffett, built their fortunes on a secret that has almost nothing to do with what you find in those documents? What if the key to beating Wall Street wasn't about being a better mathematician, but a better journalist? The secret is an old, almost forgotten technique. It's a gritty, shoe-leather approach to stock research called the scuttlebutt method. The word itself sounds antiquated, like something out of a black and white film. It means, quite simply, gossip or rumor. But in the world of high-stakes capital allocation, it is the most powerful weapon an investor can possess. It is the art of gathering information by talking to people. Talking to the customers who use the product, the competitors who fear it, the former employees who built it, and the suppliers who enable it. This is the process of building a mosaic of truth, piece by piece, from the real world, not the corporate boardroom. The average investor reads a press release and believes they understand the company. The scuttlebutt investor reads the press release, then calls 10 customers to see if the claims are true. The average investor looks at a competitor's falling market share and sees an opportunity. The scuttlebutt investor talks to that competitor's sales team to find out exactly why they're losing, revealing a fatal flaw or a coming strength in the target company. This is not about insider trading. This is about doing the hard work that 99% of market participants are too lazy, too busy, or too arrogant to do. It's about creating an information advantage that is entirely legal, entirely ethical, and devastatingly effective. Relying solely on official reports is the single most costly mistake in modern investing. It's like trying to understand a country by only reading government-issued tourist brochures. You'll see the beautiful monuments, but you'll know nothing of the culture, the economy, the political tensions, or the daily life of its citizens. You'll get a picture, but you will not get the truth. The financial transformation that this method promises is profound. You will stop being a passive consumer of information and become an active producer of insight. You will develop an almost intuitive feel for the health of a business, spotting red flags months or even years before they appear on an income statement. This journey will recalibrate your entire investment strategy, moving you from a speculator who bets on numbers to an owner who invests in realities. Today, we begin this transformation. We will deconstruct this investigative investing technique into 5 core pillars, 5 distinct investigations you must conduct to truly understand a business. This is the ultimate guide to stock picking beyond the spreadsheets. This is how you stop reading reports and start uncovering the truth. This is the final promise you will make to yourself. The first and most crucial theater of your investigation is the front line. It is the point of contact where a company's product or service meets the reality of the market. This is the customer investigation. So many investors, even seasoned professionals in wealth management, get this catastrophically wrong. They look at revenue charts climbing up and to the right and assume customer satisfaction. They see sales figures and mistake them for customer loyalty. They are looking at the smoke and assuming the nature of the fire. To truly understand a business, you must first understand its relationship with those who keep it alive. Warren Buffett understood this at an almost cellular level, long before he was the Oracle of Omaha. One of the most telling stories, a foundational anecdote that reveals the power of this pillar, comes from his 1972 acquisition of See's Candies. On paper, See's Candies was an unremarkable business. It was an aging, family-owned chain of candy shops based in California. The numbers were decent, but not spectacular. It wasn't a high-tech innovator or a rapidly scaling global enterprise. To the spreadsheet-bound analyst, it was a pass. But Buffett and his partner Charlie Munger didn't just look at the numbers. They engaged in scuttlebutt. They, along with their associate, went out and did the work. They didn't just read about See's, they experienced it. They visited the stores, they observed the customers, they saw lines out the door during holidays. They saw people not just buying candy, but participating in a tradition. They spoke to the customers and discovered something that no financial statement could ever reveal. See's wasn't just selling chocolates, it was selling nostalgia, affection, and a sense of quality and trust that was passed down through generations. A box of See's wasn't just a confection, it was the default no-risk gift for a hostess, a Valentine, a mother. To give a cheaper box of candy wasn't seen as being frugal, it was seen as being cheap. This insight was the key. Buffett realized that this powerful brand loyalty gave See's an incredible, unassailable competitive advantage: pricing power. Because customers weren't just buying a product based on its raw ingredients, but on the emotion and trust associated with the brand, See's could raise its prices year after year to account for inflation, and even a little bit more, without losing its customer base. The customers weren't doing a cost-benefit analysis, they were making an emotional purchase. This qualitative insight, gathered from real-world observation and interaction, was infinitely more valuable than the quantitative data in the company's financial records. Buffett and Munger paid $25 million for the business. At the time, See's was earning about $2 million a year after tax. To many on Wall Street, paying over 12 times earnings for a simple candy company seemed foolish. But Buffett wasn't buying the earnings of 1972. He was buying the predictable, ever-increasing earnings stream for the next 50 years, a stream that was guaranteed not by a patent or a government contract, but by the hearts and minds of its customers. Over the decades since, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, a return of 80-fold on their initial investment, and it did so without requiring significant additional capital. It became what Buffett calls a gusher, a business that produces far more cash than it consumes. This monumental success, a cornerstone of the Berkshire Empire and a masterclass in capital allocation, was born not from a complex financial model, but from the simple act of observing and understanding the customer. He didn't need to read a report to know the brand was powerful. He saw it in the loyalty of the people in line. The power of the customer investigation is rooted in a deep and often exploited psychological principle: social proof. This is the cognitive bias where people assume the actions of others in an attempt to reflect correct behavior for a given situation. When we are uncertain, we look to the crowd for cues on how to act. A long line outside a restaurant signals that the food must be good. A product with thousands of positive reviews feels like a safer purchase. See's Candies was a masterclass in social proof. Generations of Californians saw their parents and grandparents buying See's for special occasions. The brand became the correct choice, the socially validated option. Choosing another brand wasn't just a different choice, it was a socially risky one. Buffett saw that this wasn't just a business, it was a self-perpetuating cultural institution. The company's moat wasn't built of factories or distribution networks. It was built of shared memories and social consensus. When you, as an investigative investor, talk to customers, you are directly measuring the strength of this psychological moat. You are looking for signs that a customer's choice is not just transactional but habitual, emotional, or identity-based. A customer who says, "I buy this because it's the cheapest," is a fleeting asset. They will vanish the moment a competitor offers a 1-cent discount. But a customer who says, "I buy this because my father always bought it," or "I use this service because everyone in my industry uses it," is an annuity. They are locked in by psychological forces far more powerful than price. This principle explains why some companies can command enormous profit margins while others fight to the death over fractions of a penny. Companies that sell a pure commodity, like a steel producer, have virtually no psychological hold over their customers. The buyer is purely rational, looking for a specific grade of steel at the lowest possible price. Their financial performance will forever be cyclical and brutal. But a company that has successfully embedded itself in the customer's identity or social fabric, like Apple, Nike, or in its own way See's Candies, can decouple its price from its cost of production. They are no longer selling just a phone or a shoe or a piece of chocolate. They are selling status, belonging, and emotional security. The spreadsheet will show you the price. The customer conversation will tell you why they are willing to pay it. Understanding this distinction is the first step toward achieving superior portfolio growth. So how do you translate this into a practical, repeatable process? How do you build your own blueprint for customer investigation? This is where the work begins, the true due diligence that separates the amateur from the professional. Step 1. Identify the key customer archetypes. A business rarely has a single type of customer. A software company might have small business clients, enterprise clients, and individual freelancers. A retail brand might serve teenagers, young professionals, and families. Your first task is to map out who these different groups are. Read the company's annual report, look at their marketing materials, and use common sense. Step 2. Find the customers. This is the shoe leather part of the scuttlebutt method. If it's a consumer product, go to the stores where it's sold. Observe who is buying it. Talk to them. If it's a restaurant, eat there on a Tuesday night and a Friday night. See the difference. If it's a business-to-business product, this gets more creative. Go on LinkedIn and search for people whose job titles suggest they would be users of the product. Look for online forums, subreddits, or trade groups dedicated to that industry. People love to talk about the tools they use for their job, both the good and the bad. Step 3. Ask the right questions. Your goal is not to conduct a sterile scientific survey. Your goal is to have a conversation and uncover the why behind the purchase. Do not ask, "Do you like this product?" That's a yes-no question that yields little information. Instead, use open-ended, probing questions. Here is a sample script. I'm doing some research on a few products in this space. I see you're using product X. Could you tell me about the process you went through when you were choosing it? This question uncovers their buying criteria. Before you used product X, what were you using to solve this problem? This reveals the competitive landscape from the customer's point of view. What's the one thing that you love most about it? What's the one thing that drives you crazy about it? This provides a balanced view of its strengths and weaknesses. The killer question, the one that reveals everything about pricing power and loyalty, is this. If the price of this product went up by 10% tomorrow, what would you do? If they hesitate and say, "Well, I'd have to look at other options," you have a weak moat. If they laugh and say, "It would be annoying, but we're not going anywhere. Ripping this out and switching would be a nightmare," you have found a sticky, wonderful business. The final and perhaps most important question, what would make you switch to a competitor? This question forces them to articulate the company's true vulnerabilities. Step 4. Systematize your findings. Talk to at least 5 to 10 customers, ideally from different archetypes. After each conversation, write down your notes, look for patterns. Are the same strengths and weaknesses mentioned repeatedly? Is the sentiment overwhelmingly positive, negative, or mixed? This qualitative data set is now your proprietary research, your information advantage. It gives you a high-resolution picture of the company's real-world standing, something your competitors, who are just staring at spreadsheets, will never have. This process is the foundation of any serious investment strategy aimed at long-term wealth creation. To truly appreciate the power of this method, we must examine its antithesis, the path of the 99%. This is the path of passive acceptance, of taking corporate narratives at face value. The average investor, and even many so-called professionals, will download a company's latest quarterly report. They will see a line item that says revenue, $500 million, up 15% year over year. They will conclude, "Great, the company is growing. Customers must love it." This is a catastrophic analytical failure. That revenue growth could be coming from a dozen places that have nothing to do with customer satisfaction. It could be the result of a desperate, margin-crushing price cut to gain market share. It could be from channel stuffing, where the company forces its distributors to buy more inventory than they can sell, creating a temporary illusion of growth that will be followed by a painful correction. It could be the result of an acquisition that is failing to integrate properly. The number on the page tells you what happened, but it tells you nothing about why it happened or whether it can happen again. The 99% believe the CEO's letter to shareholders is a document of truth. They read phrases like customer-centric innovation and synergistic market leadership and mistake marketing jargon for business reality. The investigative investor knows that this letter is a sales document, crafted by public relations teams to present the most optimistic view possible. For example, a company might announce a strategic partnership with a large, well-known corporation. The 99% see the headline, the stock price jumps, and they feel validated. The scuttlebutt investor picks up the phone. They find someone who works at the partner corporation and asks, "So I saw the announcement about your partnership with Company X. How's that going internally? Is it a big priority for you guys?" They might discover the truth, that it's a tiny experimental pilot program that a junior vice president is running, with no real budget and a high probability of being canceled in 6 months. The headline was true, but the reality was hollow. This reliance on sanitized official information creates massive blind spots. It leads to buying into hype cycles, missing critical red flags, and ultimately suffering devastating capital losses. The path of the 99% is easier. It requires no uncomfortable phone calls, no real-world effort. It feels sophisticated because it involves spreadsheets and financial ratios. But it is an exercise in analyzing a shadow on the cave wall, forever ignorant of the form that is casting it. This is why so many retail investors fail to achieve financial freedom. They are playing a game with incomplete information, willingly accepting the sanitized story while the real story is out there, waiting to be discovered by anyone willing to do the work. The connection between this deep customer understanding and direct financial results is not abstract. It is brutally concrete. Every insight you gain from a customer investigation translates directly onto the company's financial statements, giving you a predictive edge. First, let's talk about the income statement. True customer loyalty, the kind Buffett saw at See's Candies, is the ultimate driver of gross margin. When customers are locked in emotionally or structurally, the company can raise prices consistently without a proportional increase in the cost of goods sold. This pricing power flows directly to the gross profit line. A business with a widening gross margin is often a sign of a strengthening competitive moat, a moat you can only verify by talking to customers. Conversely, if your scuttlebutt reveals that customers are price-sensitive and constantly comparing alternatives, you can predict that the company's gross margins will be perpetually under pressure, no matter what management promises. Next, consider operating expenses, specifically sales and marketing. A company with a passionate organic following and strong word of mouth doesn't need to spend as much on advertising to acquire new customers. Their existing customers become a free, highly effective sales force. When you talk to a customer and they say, "Oh yeah, I've told all my friends to switch to this," you are hearing the sound of a lower customer acquisition cost. This operational efficiency means more of the gross profit falls to the bottom line as operating income, fueling portfolio growth. On the other hand, a company that has to spend aggressively on marketing just to keep its revenue flat is on a treadmill to oblivion, a fact that is often obscured by complex accounting but is immediately obvious when you talk to customers who say, "I only tried them because I saw an ad, but I'm not sure I'll stick around." Now, let's look at the balance sheet. A business with a powerful brand and loyal customers often has a healthier cash conversion cycle. Beloved products fly off the shelves, meaning inventory days are low. Sometimes, as with See's during the holidays, customers pay up front, effectively providing the company with a short-term, interest-free loan called float. This is a concept central to Buffett's entire wealth management philosophy. Finally, and most importantly, this qualitative research allows you to assess the durability of future cash flows, which is the cornerstone of any intelligent valuation. A spreadsheet can project future earnings based on past growth rates, but this is just a mathematical extrapolation. It's a guess. Your scuttlebutt, Your direct conversations with the sources of that revenue transforms that guess into a reasoned forecast. When you have high confidence in the loyalty of the customer base, you can have high confidence that the cash flows will continue, and you can therefore pay a higher but still fair price for the business. This is the ultimate information advantage. You are no longer just analyzing historical financial data. You are developing a forward-looking, qualitative understanding of the business's core economic engine. This is how you move from simple stock picking to sophisticated capital allocation, laying the groundwork for life-changing capital gains. Your investigation cannot end with the customer. A business does not exist in a vacuum. It operates within a dynamic, often brutal ecosystem of competitors. Understanding the competitive landscape is the second pillar of the scuttlebutt method. To know your company, you must also know its enemies. You need to understand their strengths, their weaknesses, their strategies, and most importantly, how they perceive your target investment. Relying on your company's description of its rivals is like asking a general to assess the strength of the opposing army. You will get a biased, overly optimistic, and strategically dangerous answer. The foundational anecdote for this pillar of competitive reconnaissance comes not from a single acquisition, but from one of Warren Buffett's most famous and enduring investments, the Coca-Cola Company. By the time Buffett made his major investment in 1988, Coke was already a global behemoth. Everyone knew it was a great company, but Buffett's analysis went far deeper than the public perception. He wasn't just investing in a brand. He was investing in its unassailable dominance over its primary competitor, Pepsi. Buffett did his homework. He drank Pepsi. He drank Coke. He noted the difference. But his real work was investigative. He traveled, he observed, and he talked to people all over the world. He would ask small retailers, bottlers, and distributors a simple set of questions. How much Coke do you sell versus Pepsi? If you could only stock one, which would it be? And why? What do customers ask for? The answers he received, time and time again, formed a mosaic of overwhelming competitive strength. He discovered that while Pepsi might win in blind taste tests, Coke won at the point of purchase, in the minds of the consumers. The brand was so powerful that it was synonymous with the entire category of soft drinks. The share of mind, as he would call it, was even more important than the share of market. He didn't just study Coke, he studied the failure of its competitors. He famously analyzed the new Coke debacle of 1985. The company, driven by quantitative data from taste tests, decided to change its classic formula. The public backlash was immediate and visceral. It was a national event. People hoarded old Coke. There were protests. The company was forced into a humiliating retreat, reintroducing the original formula as Coca-Cola Classic. To a spreadsheet analyst, this was a marketing blunder, a write-off, a quarterly embarrassment. To Buffett, it was the most valuable market research experiment in history, and Coke's competitors paid for it. It proved beyond any doubt that the connection to Coke was not just about taste, it was about memory, identity, and culture. The moat was not in the syrup, it was in the consumer's brain. This event demonstrated the catastrophic cost of trying to compete with Coca-Cola on its own terms. He also studied Coke's international expansion. He saw how the company would enter a new market and relentlessly build a distribution system that was second to none. They would paint their logos on tiny shops in the most remote villages. They ensured that a Coke was always, quote, within an arm's reach of desire. Pepsi was always a step behind, always playing catch-up. By investigating the competition as thoroughly as he investigated Coke itself, Buffett wasn't just confirming Coke's strengths. He was understanding the very structure of the industry's profitability. He saw that this was not a business where 10 different players could thrive. It was a duopoly with one dominant king and one persistent, but ultimately secondary, challenger. This understanding gave him the conviction to invest over $1 billion, representing a massive portion of Berkshire's portfolio at the time. He knew that Coke's earnings weren't just high, they were secure, protected by a competitive moat that rivals had spent billions of dollars trying and failing to cross. This is the power of competitor reconnaissance. It defines the boundaries of the possible for your investment. The psychological principle that makes competitor analysis so critical is the ever-present danger of confirmation bias. This is our natural tendency to search for, interpret, favor, and recall information in a way that confirms or supports our pre-existing beliefs or hypotheses. When an investor first becomes interested in a stock, they typically start with a positive thesis. I think this company is a winner. From that moment on, confirmation bias kicks in. They will subconsciously seek out information that supports their thesis. They'll read the bullish analyst reports, they'll focus on the positive news articles, and they'll listen intently to the CEO's optimistic projections. They will dismiss negative information as noise, competitor FUD, fear, uncertainty, and doubt, or temporary setbacks. This creates a dangerous echo chamber that inflates confidence while obscuring risk. The act of actively investigating competitors is the most powerful antidote to confirmation bias. It forces you to step outside your own echo chamber and deliberately seek out disconfirming evidence. When you talk to a competitor salesperson, you are not going to hear about how wonderful your target company is. You are going to hear about every one of its flaws, every customer it has lost, every product feature that doesn't work. When you talk to a customer who chose the competitor's product, you are forced to confront the weaknesses in your own investment thesis. This process can be psychologically uncomfortable. It feels bad to hear negative things about a company you want to like. Cognitive dissonance sets in, the mental stress of holding two contradictory beliefs. But it is in resolving this dissonance that true insight is born. The amateur investor avoids this discomfort. The professional investor seeks it out. They understand that a thesis that has survived a brutal confrontation with its counter-arguments is infinitely more robust and reliable than one that has been coddled in an echo chamber of positive reinforcement. Furthermore, studying the competition helps you overcome the single-cause fallacy. An investor might see their target company's sales growing and attribute it solely to the brilliance of its management or the superiority of its product. But by studying the competitive landscape, they might discover a different story. Perhaps the number 2 competitor just went bankrupt, leaving a vacuum in the market. Perhaps the main rival is distracted by a messy acquisition. Perhaps a regulatory change has disproportionately harmed the competition. The growth might be real, but its cause might be temporary and external, not permanent and internal. Without proper competitor reconnaissance, you are flying with only one eye open. You see your own plane, but you are completely blind to the other aircraft in the sky, the weather fronts moving in, and the true layout of the terrain below. This deep, often uncomfortable, due to diligence, is a hallmark of any successful long-term investment strategy. So how do you build a practical blueprint for competitor reconnaissance? This is investigative investing at its finest, requiring creativity, persistence, and a healthy dose of professional skepticism. Step 1. Map the battlefield. The first task is to identify the true competitors. This isn't always as obvious as Coke and Pepsi. Sometimes the biggest threat is not a direct competitor, but an indirect one, or a new technology. A railroad company's main competitor in the 1950s wasn't just other railroads. It was the nascent trucking industry and the interstate highway system. A modern television network isn't just competing with other networks, it's competing with Netflix, YouTube, TikTok, and video games for a finite pool of user attention. You must think broadly, list the direct competitors, the indirect competitors, and the potential substitutes for your company's product or service. Step 2. Become a user of the competition. If your target company is Peloton, you need to get a subscription to Apple Fitness Plus. If you're analyzing Home Depot, you must spend an equal amount of time walking the aisles of Lowe's. Use their products. Go through their sales funnel. Call their customer service with a problem. Experience their business from the customer's point of view. This first-hand experience is invaluable. You will notice differences in quality, price, and customer experience that no analyst report can ever capture. Step 3. Mine public and semi-public information. This is where you become a digital detective. Read the competitors' annual reports, paying special attention to the risk factors section. They will often telegraph their strategic concerns. Look at their job postings. Is a competitor suddenly hiring a whole team of AI engineers or international expansion specialists? That tells you where they are placing their strategic bets. Scour industry trade publications, websites, and forums. These are often filled with candid discussions about the strengths and weaknesses of different players in the market. Find recordings of industry conference presentations on YouTube or company websites. A mid-level manager talking to a room of industry peers is often far more candid than a CEO on an earnings call. Step 4. Talk to the people on the ground. This is the advanced scuttlebutt. Your goal is to ethically gather insights from people within the competitive ecosystem. The prime targets are former employees of the competitor. Use LinkedIn to find people who used to work at the rival company. Reach out with a polite, transparent message. Hello, I'm an independent investor conducting research on the software industry. I see you used to work at competitor X, and I was hoping you might be willing to share some of your general, non-confidential insights about the company's culture and market position. I would be happy to compensate you for your time. Many people are willing to talk about their former employers. Ask them about morale, strategic direction, and what they perceived as the company's biggest challenges. Another target is the sales force. Salespeople are on the front lines. They know exactly why they win and lose deals against your target company. You can sometimes meet them at trade shows or find them through professional networks. Ask them, when you go head-to-head with company Y, what is their biggest strength? What is their biggest weakness that you exploit? The patterns that emerge from these conversations are pure gold. This rigorous process of competitive analysis creates a multidimensional view of the market. It moves you from a passive stock picker to an active industry analyst, providing a significant edge in your financial analysis and capital allocation decisions. The antithesis, the path walked by the 99%, is one of dangerous simplification. The average investor's competitive analysis, if it happens at all, is shockingly superficial. It typically begins and ends with looking at a stock chart. They will pull up the chart of their target company and the chart of its main competitor. If their company's stock has outperformed the competitors, they take this as definitive proof of superiority. This is like declaring the winner of a war based on a single day's battle report. It is confusing past stock performance with future business performance, a classic and often fatal error. The next level of superficiality is what can be called feature list analysis. The investor will go to the websites of the two companies and compare the listed features of their products side by side. They'll conclude, my company's product has 12 features and the competitor's only has 10. We are the clear winner. This completely ignores the reality of the market. Perhaps those two missing features are the only ones that enterprise customers actually care about. Perhaps the competitor's product is dramatically easier to use, or has better customer support, or integrates more smoothly with other essential software. A feature list tells you what a product can do, but it tells you nothing about its value to the customer. This shallow analysis leads investors to fall in love with technologically complex products that are commercial failures, while dismissing simpler, more elegant solutions that are winning in the market. The 99% also blindly trust market share data. They see a report that says their company has 40% of the market and the nearest competitor has 25%, and they declare victory. But market share is a lagging indicator. It tells you where the puck was, not where it's going. A deep investigation might reveal that while the company has high overall market share, its share among young, trend-setting customers is collapsing. It might reveal that the 25% competitor is winning all the new deals and is poised to overtake them in 2 years. The number is static. The reality is dynamic. The path of the 99% is to read the company's own competitive landscape slide in their investor presentation. This is the most biased, self-serving piece of information imaginable. It will always show the target company in the top right quadrant, labeled leaders, while positioning all competitors in inferior boxes like niche players or laggards. To accept this as objective analysis is not just lazy, It is a complete abdication of an investor's duty to perform due diligence. The consequence of this path is a portfolio built on a foundation of sand. The investor has no real understanding of the threats their companies face. When a competitor makes a bold move, they are caught completely by surprise. When their company's growth stalls, they have no framework for understanding why. They are perpetually reactive, selling in a panic when the news turns bad, because they never understood the underlying competitive dynamics in the first place. This is not a strategy for wealth creation. It is a recipe for wealth destruction. The financial connection between deep competitor reconnaissance and your portfolio's performance is direct and profound. A thorough understanding of the competitive landscape allows you to more accurately predict a company's future revenue, margins, and capital requirements, which are the three primary drivers of shareholder returns. Let's start with revenue. By understanding the competitive dynamics, you can better assess the total addressable market (TAM) and a company's realistic potential to capture it. A superficial analysis might show a huge TAM, leading to wildly optimistic revenue projections. But a scuttlebutt investigation might reveal that the market is already dominated by two powerful incumbents with loyal customers and high switching costs. Your target company might be fighting for scraps. This insight allows you to create a much more conservative and realistic revenue forecast, preventing you from overpaying for a growth story that will never materialize. It directly impacts the R in your PE ratio calculation, preventing you from falling into value traps. Second, profit margins. The intensity of competition is the single biggest determinant of an industry's long-term profitability. In an industry with many competitors selling similar products, what Michael Porter called perfect competition, profit margins will inevitably be competed down to near zero. Think of the airline industry. Conversely, in an industry dominated by a rational oligopoly or a monopoly, companies can price their products well above their costs, leading to fat, sustainable profit margins. Your competitor investigation tells you where a company sits on this spectrum. When you discover that a company has a unique product, a powerful brand, and only one or two rational competitors, you can confidently project strong and stable margins for years to come. This predictability is what commands a premium valuation and leads to significant capital gains. Third, capital expenditures and research and development. The competitive landscape dictates how much a company must reinvest in its business just to stay relevant. In a rapidly changing, technologically driven field, with dozens of well-funded competitors, a company must spend enormous sums on R&D just to keep up. This cash is being spent on defense, not on offense, and it is cash that cannot be returned to shareholders. A company like Coca-Cola, on the other hand, operates in a very stable, competitive environment. It does not need to reinvent its core product every 18 months. Its capital expenditures are mostly for maintenance and gradual expansion. This means a huge portion of its earnings can be returned to shareholders through dividends and buybacks, a key driver of long-term portfolio growth. By analyzing the competition, you can distinguish between a business that is a, quote, capital furnace, burning cash to survive, and one that is a, quote, capital gusher, generating cash for its owners. This distinction, which is almost invisible if you only look at a single company's financials, is critical for any serious effort at wealth management and achieving financial freedom. It is the information advantage that separates a sound investment strategy from a speculative bet. Having investigated the external forces of customers and competitors, the lens of our investigation must now turn inward. The third pillar of the scuttlebutt method is the internal probe, gathering intelligence from the heart of the organization, its employees. A company is not a machine. It is a collection of human beings, with their own motivations, fears, and ambitions. The culture of a company, the morale of its workforce, and the quality of its middle management are invisible on a balance sheet, but are among the most powerful leading indicators of future success or failure. Official corporate communications will always paint a picture of a happy, motivated, and aligned team. The internal probe is your tool for discovering the truth. The foundational anecdote for this pillar comes from an investor who is often seen as the father of this entire philosophy, Philip Fisher, whose book, Common Stocks and Uncommon Profits, was a huge influence on Buffett. Fisher was a master of talking to people up and down the corporate ladder. One of his most famous investments was in a company called Texas Instruments in its early days. In the 1950s, TI was a small but ambitious player in the nascent semiconductor industry. From the outside, it was just one of many small tech companies. But Fisher's scuttlebutt method revealed something extraordinary. He didn't just talk to the CEO. He made it a point to talk to the company's engineers, its scientists, and even its factory floor managers. He also, crucially, sought out and spoke with former employees who had recently left the company. From these conversations, a consistent picture emerged. He found that Texas Instruments had a unique and powerful engineering-driven culture. The company's leadership gave its technical talent an unusual amount of freedom to pursue innovative and sometimes commercially unproven ideas. There was a palpable sense of excitement and mission within the company. The engineers he spoke to weren't just showing up for a paycheck. They believed they were inventing the future. They talked about a management team that understood technology at a deep level and was willing to make long-term bets. This was in stark contrast to many other companies in the field, which were run by financiers or salesmen who treated the R&D department as a cost center to be managed, not a fountain of future growth to be nurtured. The conversations with former employees were particularly revealing. Fisher had a rule. He was always suspicious of a company where former employees were uniformly bitter and negative. But he was also suspicious of a company where they were all glowing. The most promising sign was when former employees expressed regret about leaving and still spoke with great respect for the company's mission and its people, even if they had left for a better salary or a promotion elsewhere. This is exactly what he found with Texas Instruments. People left, but they still believed in the company. This qualitative data gave Fisher the conviction to make a large investment. He understood that the company's real asset wasn't its patents or its factories. It was the collective brainpower and motivation of its people. This culture of innovation would allow TI to consistently outmaneuver its larger, more bureaucratic rivals. His investment was a spectacular success, as Texas Instruments went on to become a giant in the industry, playing a key role in the invention of the integrated circuit. This monumental success was rooted in an insight that was impossible to find in any financial report. It came from understanding the human element of the business, the internal engine of morale and culture that would drive its growth for decades. The psychological principle underpinning the internal probe is the principal-agent problem. This is a fundamental concept in economics and management that describes the inherent conflict of interest that arises when one party, the agent, i.e., company management, is expected to act in the best interests of another party, the principal, i.e., the shareholders. In theory, the CEO and the executive team are hired to maximize long-term value for the shareholders. In reality, their personal incentives are often very different. They might be focused on short-term stock price movements to maximize the value of their options. They might be driven by empire building, pursuing costly acquisitions that increase the size of the company and their own prestige, but destroy shareholder value. They might be focused on preserving their jobs, avoiding necessary but risky innovations in favor of protecting the status quo. The official company reports, the press releases, and the earnings calls are the agent's narrative. They are crafted to assure the principal that their interests are aligned. The internal scuttlebutt, the conversations with employees 2 or 3 levels down the hierarchy, is your window into the reality of the principal-agent problem. These employees see the gap between the official story and the daily reality. They see the, quote, pet projects that are wasting millions of dollars but are championed by a powerful executive. They see the bureaucratic rot that is stifling innovation. They feel the pressure to hit unrealistic quarterly targets, which can lead to bad long-term decisions, like cutting customer service or pushing flawed products to market. They know whether the culture is one of fear and blame or one of trust and accountability. When you talk to a mid-level employee and they say, "We all believe in the mission here, and management gives us the tools to succeed," you are getting a strong signal that the principal-agent problem is minimal. The agent is acting in the principal's true interest. But when you hear, "We're all just trying to survive until the end of the quarter," or "Management announces these grand new strategies but nothing ever actually changes," you are receiving a critical warning that the interests of management and shareholders have diverged. This divergence is a cancer within a business. It can lie dormant for years, hidden behind good-looking numbers, before it metastasizes into a full-blown crisis. The internal probe is your diagnostic tool, your MRI scan, that allows you to detect this cancer long before it becomes terminal. Overcoming the information asymmetry between management and shareholders is a key challenge for every investor, and this is the most direct way to tackle it. Creating a blueprint for the internal probe requires delicacy, professionalism, and a commitment to ethical information gathering. This is not about trying to elicit confidential trade secrets. It's about understanding culture, morale, and operational reality. Step 1. Identify your targets. Your primary targets are former employees. They are no longer bound by corporate policies on speaking to outsiders and can often be more candid. Your secondary targets are current employees, but these conversations must be handled with extreme care to avoid jeopardizing their employment. Use LinkedIn Sales Navigator or LinkedIn Premium. It allows for advanced searching. You can search for people who used to work at Company X and then filter by job title, engineer, sales manager, product manager, and seniority. You want a cross-section of the organization, not just vice presidents. Step 2. The outreach. Craft a professional and transparent message. Never misrepresent who you are or what you are doing. A good template might be, "Hello, name. My name is your name, and I'm a private investor conducting my own due diligence on the industry name industry. I'm trying to better understand the different company cultures and strategic priorities in the space. I see from your profile that you have experience at Company X, and I was wondering if you would be open to a brief 15-minute call to share some of your general, non-confidential perspectives on your time there. I am happy to pay a standard consulting fee for your insights. Offering to pay for their time shows that you value their expertise and are a serious professional, not just a random person looking for a handout." Sites like Tegus or Stream by AlphaSense have built entire businesses on this model, connecting investors with expert networks, but you can replicate the core process yourself. Step 3. The questions. Your questions should be open-ended and focused on culture, strategy, and operations, not on secret numbers. Here are some powerful questions for former employees. When you were at Company X, what was the company best at? What was its biggest challenge? Could you describe the internal culture? Was it collaborative or political? Fast-paced or bureaucratic? How was the performance of top executives perceived internally? Were they seen as strong leaders with a clear vision? What was the employee turnover like in your department? Why did people tend to leave? A killer question is, if you were CEO for a day, what is the one thing you would change? This question often elicits incredibly insightful answers about the company's biggest structural problems or missed opportunities. For current employees, if you manage to connect with them, perhaps at an industry event, the questions must be even more general. What's it like working at Company X? What are you most excited about for the future? Step 4. Look for consistency. One bitter ex-employee is an anecdote. 5 different former employees from different departments who all tell you the same story about a toxic culture or a clueless executive team is a powerful data point. You are looking for recurring themes. The goal is to build a mosaic. Does the internal view of the company's strengths align with what customers told you? Does the internal view of the company's weaknesses align with what competitors are exploiting? When these different viewpoints start to triangulate and point to the same conclusion, you are getting close to the truth. This is the essence of building a real, durable information advantage, a cornerstone for any entrepreneur or investor serious about capital allocation. The antithesis to this deep internal probe is, once again, the path of superficiality and blind trust. The 99% of investors practice what could be called CEO worship. They listen to the quarterly earnings call and are mesmerized by the charismatic, confident voice of the chief executive. They read glowing profiles of the CEO in business magazines and confuse a good public relations strategy with good leadership. They treat the CEO's letter to shareholders as gospel, never stopping to think that it was written by a committee and vetted by a team of lawyers to be as optimistic and legally defensible as possible. The average investor believes that the person at the top has a complete and accurate view of the entire organization. The reality is that large organizations are incredibly complex, and information gets filtered and distorted as it travels up the chain of command. By the time a problem reaches the CEO's desk, it has often been downplayed and sanitized by multiple layers of middle management who are afraid to deliver bad news. The CEO might not be lying. They might be genuinely unaware of the rot that is setting in on the front lines. The 99% see a company that consistently hits its quarterly earnings targets as a sign of a well-run machine. The investigative investor knows this can often be a red flag. They ask, how are they hitting these numbers? Talking to employees might reveal a culture of immense pressure, where corners are being cut, customer support is being sacrificed, and long-term R&D projects are being starved of capital, all to make the number for the current quarter. This managing for the quarter mentality is a value-destructive act that is celebrated by Wall Street in the short term and punished brutally in the long term. A tragic example of this is the story of Wells Fargo's account fraud scandal. For years, the bank was praised for its incredible cross-selling success, hitting seemingly impossible targets for opening new accounts. Analysts and investors loved the story, but the scuttlebutt, the reality on the ground, was a nightmare. Employees were under immense pressure to open fake accounts to meet their quotas. The culture was toxic and driven by fear. Any investor who had bothered to talk to a handful of branch-level employees would have heard whispers of this scandal years before it blew up, destroying billions in shareholder value and shattering the company's reputation. The path of the 99% is to trust the polished surface. They look at the company's Best Places to Work award and believe it. They don't realize that these awards are often based on surveys that can be gamed or are little more than paid marketing. To build a portfolio based on this kind of surface-level information is to build it on a theatrical stage set. It looks real from the front row, but a single step behind the curtain reveals that it's all just painted cardboard. The financial connection between the internal health of a company and its stock performance is undeniable. A positive, high-performance culture is a direct driver of long-term value creation, and a toxic culture is a hidden liability that will eventually come due. First, let's look at the impact on the income statement. Employee turnover is a massive, often hidden, expense. Every time an employee leaves, there are costs associated with recruitment, hiring, and training their replacement. But the biggest cost is the loss of productivity and institutional knowledge. A company with high morale and low turnover, a key finding of an internal probe, will have significantly lower operating expenses related to HR and training. More importantly, a motivated and engaged workforce is a more productive and innovative workforce. This translates directly to the top line: better products, better customer service, and more sales. This is the financial fuel for superior portfolio growth. A happy employee will go the extra mile for a customer, which reinforces the customer loyalty we discussed in the first pillar. The pillars are interconnected. Second, consider the balance sheet. The greatest assets of a modern company are often intangible: its brand reputation, its intellectual property, and its human capital. A strong culture is what builds and protects these assets. A toxic culture, as seen with Wells Fargo or the scandals at Uber in its early days, can inflict billions of dollars of damage on a company's brand, an asset that was built over decades. This destruction of intangible assets is a direct hit to the long-term value of the enterprise. Furthermore, a culture of innovation, which you can only truly assess through internal scuttlebutt, is what creates the intellectual property, the patents, the copyrights, the trade secrets, that will generate future cash flows. An R&D budget is just a number on a page. A culture that turns that budget into valuable IP is the real alpha. Finally, the internal probe is your best defense against catastrophic risk, the so-called black swan events. Accounting fraud, widespread safety violations, systemic harassment, these are the events that can wipe out a stock overnight. These risks almost never appear in a financial statement before they explode. But they always leave a trail. There are always employees who see what's happening. A culture of fear and silence is a breeding ground for this kind of hidden risk. By doing your internal probe, you are actively searching for the cultural red flags that signal this hidden tail risk. You are not just looking for reasons to buy, you are looking for reasons not to buy. Avoiding a single catastrophic loss in your portfolio has a more powerful positive impact on your long-term wealth creation than picking a dozen moderate winners. This is the ultimate form of risk management, an essential skill for anyone serious about achieving financial freedom through investing. Our investigation has so far examined the company's relationship with its customers, its rivals, and its own employees. But no company is an island. Every business is part of a larger value chain, a complex web of suppliers, distributors, and partners. The fourth pillar of the scuttlebutt method is the supply chain deep dive. Understanding the health and power dynamics of this ecosystem is critical. A company's strength can be undermined by a weak supplier, and its profits can be siphoned away by a powerful distributor. To ignore this part of the investigation is to leave a massive flank exposed to risk. The foundational anecdote for this pillar involves not Buffett, but his partner, Charlie Munger, and their investment in Costco. Munger's analysis of Costco went far beyond its stores, its customers, or its direct competitors like Sam's Club. He became obsessed with understanding the company's relationship with its suppliers. He recognized that Costco's entire business model was predicated on a unique and powerful arrangement with the companies that sold it goods. Most retailers view their suppliers as adversaries. The relationship is a zero-sum game of negotiation, where the retailer tries to squeeze the supplier's margins as much as possible to boost their own. Costco took the exact opposite approach. They viewed their suppliers as partners. Their pitch to a company like Procter & Gamble or Sony was simple. We will not try to make a huge profit on your product. In fact, we have a strict internal rule that we will never mark up any item by more than 15%. In exchange for this, you must give us the absolute lowest possible price you give to any retailer, and you must adhere to our strict standards on packaging and logistics. Munger, through his research and conversations with people in the industry, understood the genius of this model. For the suppliers, it was an incredible deal. Selling to Costco meant selling a massive volume of goods, with very little sales effort and a near guarantee of prompt payment. Costco was a reliable, high-volume channel to the market. This created a symbiotic relationship. Suppliers were eager to work with Costco and would often give them preferential treatment, like offering them exclusive product bundles or first access to new items. This, in turn, strengthened Costco's value proposition to its members. Customers knew, with absolute certainty, that the price they were paying at Costco was one of the lowest they could possibly find. This trust was the bedrock of the membership model, which generated a recurring, high-margin revenue stream. Munger saw that this supply chain strategy created a powerful, self-reinforcing feedback loop. Happy suppliers led to lower prices and unique products, which led to happy and loyal customers, which led to more sales volume, which made the suppliers even happier. It was a perpetual motion machine of value creation. He also investigated the dark side of the supply chain. He looked at other retailers and saw how their adversarial relationships created vulnerabilities. A retailer that constantly squeezes its suppliers might force them to cut corners on quality. They might find that their suppliers are secretly selling their best products to other, more collaborative retailers. They risk supply disruptions if a key supplier gets fed up and walks away. By conducting this supply chain due diligence, Munger saw that Costco's competitive advantage wasn't just in its big-box stores or its membership fee. It was deeply embedded in the structure of its supplier relationships. This insight, which could only be gained by looking outside the four walls of the company itself, gave him and Buffett the conviction to invest heavily. It was a classic example of scuttlebutt revealing a hidden, structural advantage that would drive predictable growth and wealth creation for decades. The psychological principle at play when we neglect the supply chain is the availability heuristic. This cognitive bias describes our tendency to rely on information that comes to mind quickly and easily when making decisions. For investors, the most readily available information is the company's own financial reports, its press releases, and the daily news flow about its stock. The intricate details of its supply chain, the names of its key component suppliers, or the terms of its contracts with its distributors are much less available. They are buried in the footnotes of 10-K filings, mentioned in passing in obscure trade journals, or not disclosed at all. Because this information is harder to access, our brains assign it less importance. We build our entire investment thesis on the easily available data, ignoring the less visible but potentially more critical information from the supply chain. A company might look incredibly profitable and fast-growing on the surface, but a deep dive might reveal that its entire business depends on a single supplier for a critical component, located in a geopolitically unstable region. The readily available information, the income statement, looks fantastic. The hidden information, the supplier concentration risk, points to a potential catastrophe. The investigative investor's job is to fight against the availability heuristic. It is to deliberately seek out the information that is not easily available, to dig into the footnotes, to identify the key partners, and to understand the nature of those relationships. This also relates to our tendency to develop tunnel vision. We get so focused on the company itself that we forget it is just one node in a much larger network. The health of the entire network affects the health of our node. A classic example is the relationship between a dominant company and its smaller suppliers. An investor might buy stock in a small, fast-growing company that supplies a critical part to Apple. The numbers look amazing, but they have failed to understand the power dynamic. Apple is a notoriously tough negotiator. They might be allowing this small supplier to be profitable for now, but as the supplier becomes more dependent, Apple can begin to squeeze its margins, effectively transferring all the supplier's profits to itself. The investor in the small supplier, who failed to do a supply chain deep dive, will be left wondering why their company's once fat margins are mysteriously evaporating. By forcing yourself to map out the entire value chain, you break out of this tunnel vision. You see the flow of power and profit through the entire ecosystem, allowing you to identify where in that chain the value is most likely to accrue sustainably. This is a critical mental model for any serious financial analysis. Building a blueprint for a supply chain deep dive is about becoming a student of the entire industry, not just a single company. Step 1. Identify the critical links. Read the Risk Factors section of the company's 10-K annual report. Companies are legally required to disclose major risks, and supplier concentration is a common one. They might not name the supplier, but they will say something like, "We rely on a single source for a key component of our flagship product." This is your starting point. Look for investor presentations that might show a diagram of their go-to-market strategy, which can reveal key distributors or partners. Use simple Google searches like company name suppliers or company name partners. You are looking for the irreplaceable relationships, the ones that, if broken, would cause significant disruption. Step 2. Assess the power dynamics. For each critical link you identify, you need to ask, who has the power in this relationship? A simple framework is to consider dependency. Does your company depend on the supplier more than the supplier depends on your company? If your company represents 80% of a small supplier's business, your company has the power. If your company is buying a commodity component from one of 20 different suppliers, your company has the power. But if your company is buying a highly specialized, patented chip from the only company in the world that makes it, that supplier has enormous power. Similarly, look at the distribution channel. Does the company sell directly to consumers, or does it rely on a powerful retailer like Walmart or a specialized distributor? If a single distributor accounts for a large portion of sales, that distributor has significant leverage to negotiate prices and terms, potentially capping your company's profitability. Step 3. Gather qualitative intelligence. This is the advanced scuttlebutt. Try to talk to people in the ecosystem. Attend industry trade shows. This is one of the best places to do this kind of research. Your company's suppliers and distributors will all have booths. Go talk to their sales staff. You can be a prospective customer. Ask them about their relationship with your target company. Ask them about their other customers. You can learn a huge amount about the competitive landscape and industry health. Find smaller, privately held suppliers or distributors and talk to their owners or managers. They are often more willing to speak candidly than executives at large public companies. Ask questions like, what's it like doing business with Company X? Are they a good partner? How does their purchasing process compare to their competitors? The goal is to get a feel for the reputation and operational effectiveness of your company from the perspective of its partners. A company that is known as a fair, reliable, and collaborative partner will attract the best suppliers and distributors, creating a subtle but sustainable competitive advantage. Step 4. Connect the dots to financials. Every insight from your supply chain analysis should connect back to the numbers. A powerful supplier can lead to rising costs of goods, sold COGS, and shrinking gross margins. A powerful distributor can limit revenue growth or demand expensive promotional spending, which bloats sales, general, and administrative (SG&A) expenses. A fragile supply chain can lead to inventory write-offs or lost sales, which are often hidden in footnotes but represent real cash losses. This investigative process transforms your understanding from a static, single-company view to a dynamic, ecosystem-level view. It is an essential component of a comprehensive due diligence process, crucial for both entrepreneurs evaluating their own businesses and investors looking for a retail investor edge. The antithesis, the path of the 99%, is to remain blissfully ignorant of the supply chain. The average investor treats the company as a black box. Raw materials and components go in one end, and finished products and profits come out the other. They spend zero time thinking about what happens inside the box or the nature of the inputs. This leads to a series of predictable and painful surprises. The most common mistake is ignoring supplier concentration. An investor will buy a stock, everything will look great for a few quarters, and then a headline hits. Fire at key supplier's factory halts production for Company X. The stock plummets 30% in a day. The investor is shocked. But the risk was never a secret. It was sitting there, disclosed in the 10K, for anyone who bothered to look. The failure was not in the company. It was in the investor's lazy research process. Another classic mistake is ignoring the power of distributors. An investor might find a small, innovative company making a fantastic new consumer product. The growth is explosive because they landed a distribution deal with a major national retailer. The investor piles in, extrapolating this growth into the future. But they never stop to ask about the terms of that deal. A year later, the retailer, now that the product is established, uses its immense leverage to demand a lower price, more favorable payment terms, and hefty fees for shelf space. The small company's margins collapse, the growth story evaporates, and the stock gets crushed. The investor who only looked at the company's income statement is bewildered. The investor who did a supply chain analysis would have seen this risk a mile away. The 99% are also susceptible to getting excited about partnerships without understanding their substance. A small biotech company might announce a research partnership with a giant pharmaceutical firm. The stock soars. The average investor buys the hype. The scuttlebutt investor reads the fine print of the deal, if available, or talks to industry experts, and discovers that the small company has given away most of the future economics of its drug in exchange for a small upfront payment. The partnership is real, but the value for the small company's shareholders is minimal. It's a headline-rich, value-poor deal. The consequence of this ignorance is a portfolio that is exposed to a whole class of risks that the investor doesn't even know exist. They're like a ship's captain who has a detailed map of their own vessel but no map of the ocean, the reefs, or the weather patterns. They are doomed to be surprised by foreseeable events. leading to a portfolio characterized by high volatility and poor long-term returns. This is the polar opposite of the stable, predictable wealth creation that a thorough, investigative investment strategy aims to achieve. The direct financial connection between supply chain analysis and your investment returns is powerful and multifaceted. A resilient and well-managed supply chain is a direct contributor to financial health, while a fragile one is a ticking time bomb on the balance sheet. First, a strong position with suppliers directly protects gross margins. A company like Costco or Walmart that has immense buying power can negotiate lower input costs, which either flows directly to their bottom line or allows them to offer lower prices to customers, driving volume and reinforcing their competitive moat. When your scuttlebutt reveals that a company is a customer of choice for its suppliers, you can have higher confidence in the stability of its cost of goods sold, COGS. Conversely, a company that is at the mercy of a powerful sole-source supplier is at constant risk of margin compression. Any increase in the supplier's price must be either absorbed by the company, hurting margins, or passed on to customers, risking a loss of sales. Second, an efficient supply chain has a dramatic impact on the balance sheet and cash flow, specifically through working capital management. A company with a great logistics system and strong supplier relationships can operate with lower levels of inventory. This reduces inventory holding costs and minimizes the risk of obsolescence and write-downs. Lower inventory means less cash is tied up in working capital, freeing up that cash for more productive uses like R&D, acquisitions, or returning capital to shareholders. This is a key driver of a high return on invested capital, ROIC, a metric that is a major focus for sophisticated investors like Buffett. A company that can grow its sales without a proportional increase in the cash tied up in inventory is a highly efficient wealth creation machine. Third, a deep understanding of the supply chain allows you to better quantify risk and its potential financial impact. For a company that relies on a single supplier, you can attempt to model the financial impact of a 6-month disruption. How much revenue would be lost? What would be the cost of qualifying a new supplier? This exercise can help you determine if the market is appropriately pricing this risk. Often, you will find that the stock price reflects a perfect world scenario, making the risk-reward proposition unattractive. This process moves you beyond simple valuation multiples and towards a more sophisticated, scenario-based approach to financial analysis. It allows you to build a truer margin of safety into your investments, not just based on price, but based on a deep understanding of operational realities. This rigorous due diligence on the less glamorous parts of a business is what separates a speculative stock-picking approach from a professional-grade capital allocation strategy designed for long-term, tax-efficient capital gains. We have now journeyed through the 4 distinct theaters of investigation: the customer, the competitor, the employee, and the supplier. Each yields a unique and valuable set of insights. But information, in its raw form, is not knowledge. A pile of bricks is not a house. The 5th and final pillar of the scuttlebutt method is the most challenging and the most crucial: synthesizing the mosaic. This is the art and science of taking all these disparate, often contradictory qualitative data points and weaving them together into a coherent, actionable investment thesis. It is the process of separating the signal from the noise, of identifying the 1 or 2 key variables that truly drive the business, and of having the wisdom to act decisively when the mosaic reveals a clear picture, or the patience to do nothing when it remains murky. The foundational anecdote for this pillar of synthesis is perhaps the greatest investment of Warren Buffett's entire career, his 1964 purchase of American Express. The story is a masterclass in assembling and interpreting a complex mosaic of information under extreme pressure. The event that triggered the opportunity was the salad oil scandal. A major customer of American Express's warehousing division, a company called Allied Crude Vegetable Oil, run by a swindler named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had used his warehouse receipts from American Express, which were supposed to represent millions of pounds of valuable salad oil, as collateral for huge loans from Wall Street banks. The problem was, the tanks were mostly filled with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied collapsed, and the banks came to American Express, demanding to be made whole. American Express's legal liability was unclear, but the potential losses were enormous, threatening to wipe out the company's entire net worth. Wall Street panicked. The narrative was simple and terrifying. American Express was going to go bankrupt. The stock price was cut in half. This is where Buffett's scuttlebutt process began. He didn't just look at the legal problem. He sought to synthesize a complete picture of the business. First, the customer investigation. Buffett went to restaurants and travel agencies. He talked to people who used American Express travelers' checks and credit cards. He asked them, "Now that the company is in trouble, have you stopped using their products?" The answer was a resounding no. Customers separated the financial scandal at the parent company from the utility and trust they had in the products themselves. The traveler's check was still the safest way to carry money abroad. The card was still a powerful status symbol. The customer franchise was intact. Second, the competitor reconnaissance. He went to banks and talked to them about their own traveler's check and credit card operations. He learned that American Express had a dominant, almost monopolistic position in the traveler's check market. Competitors had tried and failed to dislodge them. The moat was wide and deep. Third, the internal and supplier probe. He talked to merchants who accepted the card. He talked to executives at the company. He dug into the numbers and realized that the core businesses, the traveler's checks and the credit card, were incredibly profitable. They were like royalty streams on global commerce and travel. They generated immense float, the interest-free cash that customers paid up front for travelers' checks. He synthesized these disparate pieces of information. The market was focused on one single, terrifying variable: the legal liability from the salad oil scandal. This was the overwhelming noise. Buffett's mosaic building process allowed him to see the underlying signal. He concluded that the core consumer-facing businesses were so powerful and profitable that they were worth far more than the stock price, even if the company had to pay the full amount of the fraud claims. The brand was not impaired where it mattered, in the minds of its millions of users. He saw that the market was confusing a temporary, survivable, one-time loss with a permanent impairment of the fundamental business. This synthesis gave him the courage to act decisively. Buffett invested 40% of his partnership's capital into American Express stock, an incredibly concentrated bet. The bet paid off spectacularly. The company eventually settled the claims for a manageable amount. The market realized the core business was a jewel, and the stock price soared. This was the scuttlebutt method in its ultimate form. It wasn't about one single insight. It was about building a multifaceted, qualitative picture of reality that was starkly different from the prevailing market narrative, and then having the conviction to bet on that picture. The psychological principle that the art of synthesis helps us overcome is cognitive dissonance, and its close cousin, the need for premature closure. Cognitive dissonance is the mental discomfort experienced by a person who holds two or more contradictory beliefs, ideas, or values. In investing, you will constantly encounter conflicting information. Customers love the product, but a key employee just quit to join a competitor. The company has a powerful brand, but its main supplier is gaining too much power. The growth numbers look fantastic, but the internal culture seems stressed. The amateur investor cannot tolerate this ambiguity. Their brain craves a simple, clean narrative. To relieve the dissonance, they will engage in cherry-picking. They will seize upon the pieces of information that confirm their initial bias and dismiss or downplay the contradictory evidence. They achieve a state of psychological comfort, but at the cost of analytical honesty. They have forced a premature closure on their research process, creating a simple but false picture of reality. The master of synthesis, on the other hand, learns to embrace the dissonance. They see the contradictory evidence not as a nuisance, but as the very heart of the analytical challenge. They can hold two opposing ideas in their mind at the same time and not be paralyzed. Their goal is not to find a simple story, but to find the dominant force. Is the powerful brand strong enough to overcome the supplier issue? Is the great product innovative enough to compensate for the chaotic culture? Synthesis is an act of weighting. It is the process of assigning importance to different variables. Not all scuttlebutt is created equal. A dozen customers raving about a product might be more important than a single disgruntled ex-employee. A competitor's new product that is a true category killer might be more important than your company's strong balance sheet. The ability to do this weighting correctly is not something you can learn from a textbook. It comes from experience, deep industry knowledge, and a commitment to intellectual honesty. It requires you to constantly ask, what is the one thing that, if it goes wrong, kills this entire investment thesis? And what is the primary driver that gives this company its durable competitive advantage? By forcing yourself to build a complete mosaic and weigh the conflicting pieces, you are training your mind to think in probabilities, not in certainties. You are moving from a black and white view of the world to a high-resolution, full-color one. This mental discipline is the ultimate defense against the simplistic, narrative-driven manias and panics that define so much of market behavior. So what is the practical blueprint for synthesizing the mosaic? This is less of a step-by-step process and more of a mental framework for organizing and interpreting your research. Step 1. Centralize your intelligence. You need a single place to store all your scuttlebutt. This could be a physical notebook, a Word document, or a dedicated notes app like Evernote or Roam Research. For each company you investigate, create 5 sections: thesis, customers, competitors, internal, and supply chain. As you conduct your research, populate these sections with your raw notes from conversations, observations, and readings. Don't edit or filter at this stage, just capture the information. Step 2. The inversion test. Before you try to write out your bullish investment thesis, force yourself to write the bearish one. This is a powerful technique popularized by Charlie Munger. Based on all your research, write a 1-page document titled, "Why This is a Terrible Investment." List all the negatives you've uncovered, the competitive threats, the cultural weaknesses, the supplier risks, the customer complaints. This act of intellectual inversion forces you to confront the counter-arguments head-on and prevents you from falling in love with your own ideas. A great investment is often one where the bear case is well known, but your research shows it to be survivable or misunderstood. Step 3. Identify the key drivers and the moat. Now, review all your notes and ask the critical question: what are the 1 to 3 variables that truly drive the long-term success of this business? This is the search for the company's moat, or durable competitive advantage. Is it a low-cost production process, a beloved brand, a network effect? High switching costs for customers, a unique distribution system? Your scuttlebutt from all 4 pillars should point towards the nature and durability of this moat. In the See's Candies example, the customer investigation revealed a brand moat. In the Costco example, the supply chain investigation revealed a cost and scale moat. Your synthesis must identify this core engine of value. If you cannot clearly articulate the moat in a few sentences, you probably don't have a good investment. Step 4. The final thesis write-up. Now, you synthesize everything into a final investment thesis. This should be a 2 to 3 page document. It should start with a clear, concise statement of why you believe this is a good investment. It should then present the evidence, drawing from your scuttlebutt across all the pillars, to support your claims about the company's moat. Crucially, it must also include a section explicitly addressing the primary risks and the bear case you developed earlier, explaining why you believe those risks are manageable or outweighed by the positives. This document is your intellectual anchor. It is the culmination of your investigative investing process. When the market panics and the stock drops 20%, you don't panic. You reread your thesis, Has anything fundamentally changed in your mosaic? Or is this just market noise? This document is the foundation of the conviction needed for any successful long-term investment strategy. The antithesis, the path of the 99%, is the path of the story stock investor. This investor does not synthesize a mosaic. They fall in love with a simple, emotionally appealing story. The story might be about a disruptive new technology that will change the world, a visionary CEO who is the next Steve Jobs, or a product that is curing a terrible disease. The story feels good. It is easy to understand and easy to repeat to others. The investor becomes so enamored with this single narrative that they stop doing any real research. They ignore all disconfirming evidence. In their mind, the company is not a complex entity operating in a competitive environment. It is the protagonist in an epic tale destined for a happy ending. This leads to a complete failure of synthesis. Instead of weighing all the evidence, they simply filter it. Any information that fits the story is amplified. Any information that contradicts it is ignored as FUD from jealous short sellers or clueless old media journalists. They see a glowing customer review and it confirms their thesis. They completely ignore the fact that the company's top engineers are all leaving for a competitor, a critical piece of scuttlebutt that would shatter their simple narrative. The result of this approach is a portfolio of lottery tickets. These story stocks can sometimes have spectacular runs, fueled by hype and momentum, but because they are not backed by a deep understanding of the underlying business fundamentals, they are incredibly fragile. When the narrative breaks, when the disruptive technology proves harder to scale than expected, when the visionary CEO's promises fall short, when the competition catches up, the stock price collapses with breathtaking speed. The investor who fell in love with the story is left with devastating losses and a profound sense of bewilderment. They will often blame market manipulation or bad luck, never realizing that the true failure was their own intellectual process. They chose a simple story over a complex reality. They chose premature closure over the difficult work of synthesis. This is why the portfolios of so many retail investors are a graveyard of the next big thing stocks that they bought near the top and rode all the way down. They lacked the discipline of the scuttlebutt method and the intellectual honesty required to build a true mosaic. The financial connection of a masterful synthesis is the ultimate prize of this entire process. It is what translates all your hard investigative work into tangible financial results and superior capital gains. The primary outcome of a successful synthesis is an accurate and high-conviction estimate of a company's intrinsic value. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. A spreadsheet can give you a number, but it's garbage in, garbage out. The quality of your inputs determines the quality of your output. Your synthesized scuttlebutt provides vastly superior inputs. Your customer investigation gives you a better forecast for long-term revenue growth and pricing power. Your competitor analysis gives you a more realistic view of sustainable profit margins. Your internal probe gives you insight into the execution capabilities and capital allocation skills of the management team. Your supply chain deep dive helps you assess the stability of costs and the risk of disruption. When you put all these qualitative-driven inputs into your valuation model, the resulting estimate of intrinsic value is no longer a wild guess. It is a well-reasoned judgment. This leads directly to the concept of margin of safety, the cornerstone of Buffett's entire philosophy. The margin of safety is the discount between a company's stock price and your estimate of its intrinsic value. A successful synthesis gives you the conviction to act when this margin is wide. When the market panics over a short-term issue, like the salad oil scandal, your mosaic allows you to see the long-term value and buy with confidence. It is this conviction, born from deep research, that allows you to make the large, concentrated bets that are responsible for truly life-changing wealth creation. Without synthesis, you might buy a little bit of a stock, but you will never have the courage to make a meaningful investment. Furthermore, the synthesis process dictates your holding period. When you have built a complete mosaic and understand the core drivers of a business, you are less likely to be shaken out by meaningless short-term stock price volatility. You will be able to hold your great investments for years or even decades, allowing the magic of compounding to work. This long-term holding period is also incredibly tax-efficient, maximizing your after-tax returns and accelerating your journey toward financial freedom. Ultimately, the act of synthesis is what elevates you from an information gatherer to a true investor. It is the final, critical step that turns research into returns, and it is the skill that separates the enduringly successful from the temporarily lucky. It is the final promise of the scuttlebutt method, not just to see the pieces but to understand the whole. You have now been given the blueprint. You have received the schematics for a powerful mental machine, an investigative framework that can fundamentally transform your approach to the market. We have journeyed through the 5 pillars: the customer, the competitor, the employee, the supplier, and the final, crucial art of synthesis. You now possess a tool that, if you choose to use it, will give you a profound and sustainable edge over the 99% of market participants who remain chained to spreadsheets and sanitized press releases. You have invested your time to acquire this knowledge, and that investment has armed you with a new way of seeing. You can no longer look at a rising revenue chart without asking, but what are the customers actually saying? You can no longer celebrate a market share gain without asking, and how are the competitors reacting? This is a permanent upgrade to your mental software. But it's crucial to understand that what you've mastered today is one powerful network of models within a much larger system. The scuttlebutt method is the tool you use to gather intelligence, to understand the reality of a single business. But it is one piece of a much larger map. It tells you what is. It doesn't on its own tell you what it's worth or when to buy or how much to risk. Warren Buffett's complete system is an interconnected web of mental models. The scuttlebutt method feeds directly into his concept of the circle of competence. The deep research you do is what defines the boundaries of what you truly understand. That, in turn, informs his principle of margin of safety, the discount you demand between price and value. And all of that is governed by the overarching philosophy of treating a stock not as a flickering ticker symbol, but as a piece of a tangible business. Each principle is a link in a chain, and together they form an unbreakable framework for capital allocation and wealth creation. The video that is now appearing on your screen is not an accident. It has been selected by an algorithm that understands your journey. Think of it as the next piece of the map. It is the link that connects the intelligence you've learned to gather today with the discipline required to act upon it. The choice to click is not about watching another video. It is a declaration of intent. It is a signal that you are not a tourist in this world of serious investing, but a citizen. It is the choice to continue your ascent, to forge the next link in your own chain of mental models, and to complete the intellectual arsenal required to secure your financial future. The map is in front of you. The next step is yours.